ليه؟ ليه؟ هو كل عبط. لا
ما حسيتش حالي مرتاح.
أنا جاكز شوي.
ما حسيتش حالي مرتاح.
كنت
والله ما حسيت.
You did good.
ما حسيت.
سيء. لا ما حسيت والله نور. كنت زي ما بدي إياك، كنت هادي وشوي بالضبط زي ما
in international engagement. And then the next speaker I'll be presenting is Dr. Matthew Lane. He is a B runner and now chair
to save you.
at Morehouse College. He's a rising star in finance research. Dr. Lane has published multiple research papers
أول مرة نخش.
on investment strategies and technical analysis. His work has and will continue to develop the future of business leaders and contribute significantly to both academic and professional finance communities. Let's put our hands together and welcome him to the stage.
كل شغلات نسيتها.
You did great.
والله ما رمزت.
والله عملت.
ما كنتش مرتاح. I know my.
I think you did great.
مش في بريك. ممكن نحط أكسجين بس.
All right, thanks everybody. So today, I have the privilege to speaking with Dr. Louie, and what we're going to do is we're going to talk about a paper that I wrote and a paper that he wrote that all incorporate both of them fundamental analysis, technical analysis, into a tactical quantitative model to produce the goal of successful financial outcomes. So, I just said a lot of different words there, so maybe we can start by defining what
I'm
those
really new
words
to
mean.
this whole thing.
So,
Well, I didn't know.
technical, let's start with
He did not buy enough
capital
for me.
care.
I mean,
What are
yeah,
capital
he generously
flows? Well, the
donated
technical analysis,
to the
capital flows
$150,000.
is the money. Okay,
Yeah,
is
but
money flowing in
his
or
legacy's
out
gonna
of,
live on.
out
you know?
of the stock or the stock markets.
Come here.
And in
Kabir is
fundamental
still there. He's still
analysis,
very
capital is
active, you know.
money.
So active, right?
Yeah,
Is
I mean,
the
he
company
publishes like
producing
100
profits,
papers a year.
Or is it?
None of them
or
are.
is capital
His
flowing
resume is a
out
book.
producing
Yeah.
losses?
His resume.
Yeah,
Okay.
yeah, absolutely.
Uh,
Are you researching?
Fundamental analysis is about the company. Okay?
We are
We're
teaching
analyzing the company.
Okay.
Technical
And
analysis
actually, our fund is
is
newer than
about
yours.
the market
That's a 2020.
and
So it's a
people's
very, very
behavior.
new.
Okay, are they
And,
buying or are they
Previously,
selling?
I worked at the
Um,
other institute,
Tactical.
and then I was.
Okay,
hired
that's your asset allocation.
Georgia.
Okay, tactical means that you're
to
taking
establish the fund,
position bets
which is the major judge.
between stocks, equities,
Speaking of that,
bonds,
you said that you have
cash,
a class
or alternatives.
right?
So it's not static or
Investment fund
changing.
activities.
Yes.
Okay,
Would you
quant
be able to share the syllabus and that
basically
content
means
again?
that your
Yes, yes.
algorithm.
So
Okay.
I'm not teaching it right now, but I do have.
So a little bit about myself.
I'm gonna start
I'm
teaching it in
a
the
charter
fall,
market
which is why I'm
technician.
getting involved in this conference.
CMT.
because I'm- So,
I
but I have the
manage
material,
money
I can share it.
For
To email that I
individuals,
gave you
high net worth
from my car.
individuals
Okay,
and
yeah. You
institutions.
could do that.
I'm also
When I
the
was there,
chief
there was
market
only one time per
technician
How
or
many
Chief
terms
Market
we have?
Technical Analyst, CTA,
Yeah, but I
Kingsview,
still have
which
your
is
email.
a
What is
7
the
billion
what is the
national
use as a
RIA.
platform?
And most recently, I've now
So we use
a
the Bloomberg terminal.
portfolio manager,
Access to
index
Barron's.
manager for
Barron's-
two
Barron's Market Watch.
ETFs that
Oh,
utilize
okay.
my
Do a
strategies,
donation.
Monarch ETFs.
And yeah, I think that's it. That's all we use.
So,
But we do have access to like
today we're
LSEG
gonna,
and like
I'm
copies
gonna
that
present
Chris, but that's
our
lacking.
models,
That's like
okay,
one
my
year.
most recent model.
So
And just
it's
give you a
not
little
up to-
background on this model. This
But
was
yeah,
a
I
fund,
could definitely share
the largest
material.
sector
I mean, if
company
you just shoot me an
came to me
email or I'll
and gave me a grant to
if you
provide
wanna take
some
my number,
research
I'll-
on how do you use
do?
capital flows
And then
within
that way,
exchange
just
traded
like if I
funds,
forget,
particularly
you can text
sector,
me.
because that's
And I'll
where
immediately
they
send
were
it.
invested in, with the idea of
That's you.
creating a fund of funds for their sector ETFs. So this is where
Yeah, that's cool.
it
Okay.
all started, with the
Okay.
goal of this fund to create successful financial outcomes.
Just
And what are
wait for me.
successful financial outcomes? It's not just returns, okay? Returns are good, right? That's what gets you the
Young
money,
key. Yeah.
okay? Okay? But successful outcomes are about managing the risk, okay? Especially here now that we're in the distribution phase, okay? So there's a saying out there, alpha
Where's
will raise the
what's
money, but low
the
beta,
Lanio, which is
that's
one
what keeps the
hour
money,
away from
allows you to maintain the money.
Oh, okay.
So we're gonna talk about, defense,
I'm gonna text you my name.
preserving capital. We're gonna talk about
Alright,
offense,
alright, nice.
which is your security selection. And we're gonna talk about special teams when you're tactical, okay, and you're defensive, okay? How do you get back on offense? Because generally, the biggest moves are when the market's already down, okay? We saw that on Tuesday, right? Okay, huge moves when the markets are down. So how do you how can you quickly, if you're on defense, switch back to offense as special teams? And then we're gonna combine it all together into one model, okay? So, defense. What do they say about defense? Defense wins championships. Why does defense win championships? Because if you've got a good defense, you're always in the game. Okay, so one of the approaches to have a good defense is to follow the trends. Okay, and what this research shows, going back to the 1920s, is if you just follow the trend, whether it's the 10, the 20, the 50, the 100, or the 200 moving day average, you've beaten the market and taken significantly less risk. Of these, the most popular is the 200-day moving average. Why? Because it has the least amount of turnover. Now, that said, more recently, and when I say more recently, it's the last 3 decades, that strategy of following the 200-day moving average hasn't worked out. The red line here is the S&P, and the blue line is following the 200-day moving average. Okay, so you've underperformed by about 2.5% annualized by following the 200-day moving average. It did significantly reduce the risk in the portfolio, okay, but not enough to have better risk-adjusted rate of returns. So that strategy, as of recent, has not been working. So what I've done, and this was kind of the start of that funding project, the thesis, as you will, is that we don't want to look at price trends, nor do we want to look at ETF volume, but we want to look at the true volume. When I say true, this volume is manipulated. It's not what you get off of Bloomberg, but it's repaired, okay, and this is capital weighted volume. So by using either capital weighted volume or capital weighted capital flows, which is how much money is moving in or out of the stock market, using either one of these trends, we are able to meet or beat the S&P in returns while maintaining the properties of significantly less risk. Thus, we're able to produce similar returns to buy and hold with significantly less drawdown and significantly less volatility. Okay? The other thing we're going to do is we're going to combine volume momentum. Okay, so and we're going to use, momentum. We're going to use is a physical property. So we're going to look at physics here. And what are the 3 laws of motion? Newton's law. First law: an object in motion remains in motion at a constant speed in a straight line, unless acted upon by an unbalanced force. Okay, so what is that unbalanced force? That's volume. Volume is the unbalanced force that causes price change. Second law of motion. Okay, the acceleration of an object depends upon the mass of the object and the amount of force applied. So what we can say then is that price acceleration, momentum, is powered by volume. And then the last one here, whenever an object exerts a force on another object, the second object exerts an equal and opposite force. So the equal and opposite, what is that? That's a symmetry. The difference between price momentum and its volume illustrates an asymmetry, and that is the most important piece as we look at momentum. So what we're going to do next is we're going to test this first this first law of motion, and we're going to look at volume momentum. And on this chart here, what we did is we took the stocks with the best, strongest volume momentum, the top 2 of the 11 sectors, and we looked at these 11 sectors, and we took the top 2 with the strongest volume momentum. Then we took the 2 with the least amount of momentum, and we compared that to the S&P and all 11 sectors. And what we found is that the stocks with the highest momentum, the two sectors had the best return, and the stocks, this is more important, the stocks with the least amount of momentum significantly underperformed. So there was about a 4.5% delta between the stocks with most momentum versus the sectors with the least momentum. Okay? And particularly that second piece, the stocks with the least momentum, that comes back to our defense. So not only can we identify the strong sectors, but we can eliminate the sectors with weak momentum and create that for defense. Okay, the blue lines in this chart shows, based on the top performing group, which was strong momentum, when you were invested in these various sectors. So if you see a blue dot, that means you were invested at that time in that sector. You can see there's a lot of diversification between when you're rotating in and out of sectors. And by the way, this was done quarterly. Okay. So offense. Offense, I mentioned before, is your security selection. Next, we're going to look at that asymmetry, the volume momentum compared to the price momentum. And you can see that this blue line, we're looking at the top 3 sectors based on that price volume asymmetry, significantly outperformed the market and all the other sectors. Okay, so we added a lot of alpha and kept a lot of diversification. Okay, now we're going to add in the fundamental piece. Okay, so what we did here is we're looking at fundamentals, cash flow. This is all about cash flow. Okay, so now we're looking at cash flow through profits and losses. And what the metric that we used was free cash flow divided by enterprise value. Okay, so I like free cash flow because free cash flow is a number that really can't be manipulated, unlike profits. So this is how much money the company made or how much the company lost. Okay, divided by enterprise value, which is the valuation of the company. So and then plus the debt. Okay, so this is basically the how much would you have to pay to buy out the company. Okay, so this is how much free cash flow they have divided by the value of the company. Okay, and notice here that we get significant alpha with looking at free cash flow divided by enterprise value. Now, one caveat. Okay, there's something here that you should know. There's one sector that has dubious free cash flow typically, and that's the financial sector. Okay, that's because they have deposits and they have withdrawals, and it makes it hard. And because of that, they always seem to have very high free cash flow basis. So what we did is we took it out. Okay, so it doesn't have financials. And financials were by far the worst performing sector in this period of time. Okay? But there's another line here I added. Okay, and that is the purple line. Okay, the purple line is tech, healthcare, and discretionary. These were the 3 top performing sectors during the period of study. So if you were a prophet and you knew ahead of time which of the 3 sectors you should have bought ahead, you still couldn't have beat free cash flow divided by enterprise value. Now, another problem with this is it's very concentrated. You see that utilities, real estate, they're almost never invested in. Actually, they weren't. So next what we're going to do is we're going to combine these 2 together into one strategy. You can see that we, by combining our 3 pieces together, we improve our return. Okay, next week, we're going to talk about special teams. Special teams, again, is that transition from defense back to offense. Okay? And what I'm illustrating here again is the S&P. This is the chart we looked at earlier. Okay? Except we added something. We're adding capitulation bottoms. Okay? So when the market's capitulating by volume, we're going in. So there's V's and there's W. VWs and W bottoms. And what that does is it increases our rates of return because we're getting back in when the market's showing these capitulation signs. Okay, and so last, this is putting in all 3 pieces together. So this is how the strategy works. Okay, the strategy first identifies and weeds out the sectors that don't have that don't have positive trend as far as capital flows. Okay, we screen out all those first. Okay, then we take out the 2 sectors that have the weakest momentum. Okay, that's the defensive screen. Once we weed those out, then we rank them according to volume momentum, volume asymmetry, and free cash flow. Okay, and then the last piece is if it's in a defensive position. Okay, and we get this capitulation signal, we take off that defensive position and we go back to offense. Okay, and that is the blue line. And what we've demonstrated with in this portfolio is that we get about 5% alpha with about 60% beta, and that's what produces successful financial outcomes. Next, I'm going to turn it over to Dr. Ludy, who's going to go through these sectors more on a granular basis, as opposed to just looking at sectors. He's going to say, what if we modify these sectors with additional analysis? So I'll turn it over to Dr. Ludy.
So I spent a good amount of time learning from Buff, his VPCI indicator, and he published recently a book in this past summer, 2024. So I started to learn a little bit about some of the back tests that were in his book, and then combine it with some of the indicators I was looking at already from him. So I apply a couple different rules to 11 sectors here. I'm sure you're familiar with what the sectors are already. So I'll just summarize some of the work that I went through. His VPCI indicator, I combine it with a moving average over 10 periods. So basically the goal is to eliminate the low momentum stocks. So VPCI above -0.4, and then use that as a buy rule, and then sell when the moving average, when the price is below the moving average.
So just what is VPCI? That's volume price confirmation indicator. And what that does is looks at, and we talked about the asymmetry of momentum. The VPCI is the asymmetry of a price trend versus the asymmetry of a volume-weighted price trend. That's what that's about. So we're looking at how is the price trend moving, and is the volume confirming or contradicting what's happening in the price trend.
Makes sense. So I'll skip over the equations for it. This is just going through the construction of the BPCI. I also built out a discounted cash flow screen. I'll come back and go over this as well as a CanSlim screen. So let me go through the BPCI screens first, and I'll try to finish on time since I know we're over time. If there's time, I'll go back and do the discounted cash flow and the CanSlim. So this is communication services over 30 years using the BPCI moving average. The blue line is the equity, the red line is the index, and then the yellow is cash. So it starts in 1995, it finishes in 2025. Starting balance is 100,000, ending balance is 934,146.05 for 834.1% profit. 1,300 trades rebalancing every month during that period, with about 4% weight per trade. So it just looks at all the stocks that are on the communication services sector, applies that rule to it, and then at the end of the month updates the portfolio and drops all the stocks that are below the moving average. And if they're above both the BPCI and the moving average, they stay in the portfolio. So I use the same rule on the remaining sectors. This is consumer discretionary. It does 31,447,938, which is 31,347.9% return, 2,343 trades. There's other summary statistics I can go through, but for the sake of time, I'll just go through the rest of the sectors and talk about the equity curve and the percent profit. And then if there's time, I'll go through the other two screens that I did. This is consumer staples, 100,000 into 3,889,248, 3,789.2% profit, and 2,498 trades. So the blue line is the equity, the red line is the sector, the yellow is the cash, the red at the bottom is the maximum drawdown. So the annualized return is 14.3%. So I started at 30 years and then went back 10 years, 5 years. I also looked at 20 years, 25 years. So the first presentation talked about you want a strategy to hold up over time. It's not the back-tested returns, it's the forward-tested returns. So having a common set of rules, working over overlapping time frames like 30 years and then 20 years and then 10, 15, 5 is a good indication that it should continue to work in the future. So I saw some variability going back 10 and 5 years with the technical screen, that it works really well over the longer time periods due to the recession periods, and technicals performing well during those periods, but over the last 10 and 5 years it starts to lag the market some. The other two screens that are more fundamental focused, they have variables performance over 30 years, but improve over 10 and 5 years. So there's good indication that combining the three screens together would be a reasonable portfolio tool. Energy over 30 years is shown here. Doesn't outperform as much as the others. Financials does really well. Healthcare does well. Industrials. So the blue's the equity. Technology does the best, 108 million, 727,000 over 30 years. Materials, and the last one is real estate. So let me back up and go through the other two screens that I built out. This screen, which is technical, was carried out in Optima. If you have a CMT partnership, the Optima platform's included if you register for the exam. So that was something I did when I was registering for the level 1 exam I took and passed in June. I built these portfolios around that time, looking at Buff's book and then learning from him how to do it. The discounted cash flow screen I built recently, I was in San Antonio presenting at a conference called Southwestern Finance Association. And I was coming back and looking at the sectors some more and trying to think about what screens might work. So we do discounted cash flow in class. I'm sure you're familiar with discounted cash flow. In Bloomberg, you can use the EQS equity screen and then the formulas to build out custom formulas. So I built out a formula to approximate a 5-year DCF using point-in-time estimates for free cash flow, point-in-time estimates for anticipated growth rate, and then fixed assumptions for long-term growth rate and WACC. You can't get point-in-time WACC in Bloomberg. So then I discounted the cash flows back, created the enterprise value, and then made the adjustment from enterprise value to per share value. And so that snippet is taking the rank of the per share value percent growth compared to the current price of the stock at that point in time. So if you're with me so far, the DCF will give you a price estimate, and you compare that price estimate to the current price of the stock, and then you make your buy or sell rule based on if the anticipated price is above the current price, or you buy, if it's below, you'd sell. And so I took a rank of all the stocks that are in the range of that index. So basically looking at your stock's growth rate compared to all the other stocks' growth rate, and then taking the top 10%, and then rebalancing every month. So that's that rule. CanSlim also is from a paper I wrote with Tarun Mukherjee. He was the donor for the second presentation at UNO. I did my PhD at UNO in finance and graduated in 2019. So we had started this topic when I was a PhD student, and then we published it in Applied Finance Letters in 2023. So I rebuilt it in Bloomberg, following the rules here from the paper. So I'll go through those screens with you. Over 30 years, CanSlim lags communication services. DCF also lags. There's some variable performance, and then just keep in mind how well BPCI did on these sectors. And then I'm not showing the last 10 years or the last 5 years, so the theme is that the fundamental screens do a little bit better over the last 10 and 5 years, while the technical screens lag. So I think there's some synergy between the three different portfolios that might make a decent strategy. CanSlim on consumer discretionary does well. DCF lags. On consumer staples, it lags. DCF beats it by quite a bit. On energy, CanSlim really crushes it, I think even better than the BPCI rule. Does 89.91 compared to the benchmark, which was 1400. DCF lags it quite a bit. Financials, it does 2075. The benchmark does 1345. DCF does 5000. The benchmark does 1400. Healthcare is 38 on CanSlim compared to 2500. DCF does 10,000. So some of these have very strong returns on individual sectors over the long time frame. And in the larger slide deck, I go through like 30 years, 10 years, 5 years for each one, and then just look at, you know, which ones consistently outperform, which ones, if they do really well in the long term, do they continue to do well over the short run? If they do well in the short run, how do they do in the long term, that kind of thing, and compare the three together. Industrials is about the same for CanSlim as the benchmark. For DCF, it crushes the benchmark, 4,500% compared to 1950. Technology is about the same for CanSlim. DCF, it struggles. Materials, CanSlim doesn't do very well. DCF, it does almost double. CanSlim real estate doesn't do well. It doesn't do well for DCF either. So there is a theme of certain sectors doing well. Canceling seems to struggle with, certain sectors, and DCF does too. So, I go through more of that in the larger slide deck. Here we can see they tend to be mixed on the longer horizon. Utilities, canceling does 2960 compared to the benchmark of 1106, and DCF does 3175 compared to 1094. So I think these are showing good application that might be useful for student funds. I work at Morehouse College, and we're getting a $4 million student fund grant, which is part of a project acclaim for HBCUs, and it's a donation which is joint between UNCF and Adage Capital. And I'm not too sure how this will overlap with that, but we're rolling it out in the fall, so spent a good amount of time trying to go through and build these screens. I've been working with the Bloomberg rep quite a bit on equities, and taught myself working with her how to do this kind of stuff, and spent a good amount of time building on back testing. I'm trying to organize the data, see if there's a theme and what does well, what doesn't do well. It seems like these three seem to do pretty well. I also tested a book to market screen and a high free cash flow screen, which I didn't show, but those seem to do well too. So I finished a lot faster than I planned on, but I was hoping to finish by 11:30, so there's about 15 minutes left. I don't know if you have anything you want to add, Buff, or if there's any questions about either one.
Yeah. I've done a lot of test work myself, and for DCF to enterprise value is the best single stock selection formula by far. That's why I tell my students, with Desert Island, you only get one piece of information, give me the free cash flow estimate. So have you used FTW feature in Bloomberg? Because that will show you for the past like 30 years which factors work the best in each of the sectors on a long only and a long short basis. So like it's basically back test data that's already been done by Bloomberg that you can go in and say, okay, financials, what are the best factors for generating alpha? What are the worst? And, you know, it varies by sector. DCF is best across all 11 sectors, but there's certain individual factors that work better than others on a sector by sector basis. And that's all like pre-programmed like FTW Go.
I'll take a look at it. I think I've heard of it, but I don't think I've dived into it. So I'll take a look at it.
About, can you explain the idea of the capital weighted volume and the volume adjusted momentum conceptually? What do those mean?
There's a whole presentation. But let me try to simplify it. So if you look at traditional volume, there's two major issues with volume. And if you look at and you try to use the volume that you're pulling, it just frankly doesn't work. Okay, and there's again two major reasons why. Okay, the first reason is that how the index is compiled. So you want to look at S&P volume, right? You're looking at the S&P. You want to look at the S&P 500 volume. Most of your charts, when you pull up the S&P 500, it's going to be missing the Mag 7 stocks. Why is that? Because when you pull data, they're looking at exchanges. They're not looking at indexes. So generally, you get the New York Stock Exchange data. So you're not getting S&P, you're getting the New York Stock Exchange, or tape A. Okay. So you got apples and oranges. Problem number one. Problem two, you think that's bad. Problem two is worse. Okay, and give you an example of this. Volume is tallied, okay? And the problem with tallying volume is that the little stocks get more weight than the big stocks, all right? So give you an example of Citigroup. And before the credit crisis, Citigroup was 5%, it was one of the top 5 stocks in the S&P by capital weight. By the end of the credit crisis, it had like 0.1 weighting in the S&P because Citigroup crashed and became a penny stock. They eventually had to do a reverse split, which helped correct it. But before that, Citigroup, although it had almost no attribution to the S&P, was 20 to 30% of the S&P 500's volume. So what we did is I repaired that data, the volume data, and cap weighted it. So just like the S&P is cap weighted, the volume is cap weighted. That makes a huge difference in using volume on an index basis. Okay, I answered one of your questions. What was the second one? Oh, the momentum?
The adjusted momentum, I guess.
Okay, a volume adjusted momentum. Okay, so what we're looking at there is the momentum of the stock, let's say, or an index, or like a sector. Okay, what is the price momentum? Okay, and then we take into account and contrast that to the volume, the capital weighted volume of that sector, which includes the price, but also how many people participated at that price. Okay, so that's what we're looking at. Okay, the asymmetry between price and how many people actually participated at that price. Okay, volume's kind of like to describe it like this. Volume's of fuel. All right, so if you're flying an airplane, you want that plane to go higher, and it keeps on going higher, and you adjust it to go higher, but don't give it more fuel, what direction is that plane going to go? It's going to go down, okay? Because you have to give it fuel for it to compensate. Volume's of fuel because it's capital that pushes markets up, okay? So we're looking at capital. Go ahead.
You mentioned that Bloomberg is not maybe the best platform to get all of that info. So what have you used, essentially?
So I had to create it myself. So basically, I can create this through Bloomberg, but I take, when I'm running my funds, I pull the data from the Bloomberg, and then I reorganize it. So that, the key part, and because the reason you can't find this on most platforms is you have to know to calculate capital weight volume of shares outstanding. That's the hard part, okay? And then to backtest, you have to know that historically, which is very difficult to information to garner. Really good questions. Do you have anything? Anybody else have any questions? Yes, go ahead.
You mentioned that you wrote a book last summer. What was the name of the book that you wrote?
I'm sorry, I didn't hear you. Oh, the book. Okay, so my second book is the volume factor. Okay, and what I've done in the volume factor is what we're trying to do is twofold. One is how do you create successful financial outcomes? Again, key to that is not only creating returns, but successful outcomes, particularly in the distribution phase, are about managing risk. Okay? How do you manage risk? And the second theme is the title of the book, is that volume is not only a leading indicator, it's actually a factor. And Dr. Ludi did some work on this, and he tested the volume factor in the French market and the French model, and discovered that it was not 10 times greater than the strongest factor, but over 100 times greater than the next strongest factor.
Good question. How is that measure of volume different from the VWAP, the volume weighted average price that we see on the most platforms?
It's very similar. The problem with VWAP is very short term. So when you're looking at a VWAP, you're looking at it's from the point. So VWAP is is used by traders to measure whether they're getting a good execution. So basically, what we did it with I created what's called a volume weighted moving average that is really the basic building block of that, where you take it looks just like the VWAP, except you can go back further in history. Okay, so it's not segmented by point to point, but actually an average over time. Anything else? All right, well, I appreciate all your, all those.
اوكي، البنت العجيبة هاوس الثاني او الهاوس لا